Welcome back everybody, my name's Leah.
And I'm AK.
And we are property investors. If you're new here, we make videos all about property investing, business and working together as a couple.
And in this video, we are talking about the 5 reasons to open a limited company with which to purchase buy-to-let properties.
Now, before we get into some of the reasons why you should consider the advantages of operating under a limited company umbrella, we want to talk about who this video is really for.
Well, if you are investing in property and you're thinking about opening a limited company or an SPV, a special purpose vehicle to purchase these properties in, and generally speaking, if you are a higher rate taxpayer and you want to grow your property portfolio, then a limited company could be best for you.
Or if you're currently a basic rate taxpayer and you're paying 20% tax on the income you are making, and you're looking to become a professional property investor and have 4 or more properties in your portfolio, a limited company might also be the best vehicle for you to buy your properties in.
Now, please remember this isn't financial advice, so make sure that you speak to an accountant that specialises in property before you do anything.
Let's talk about the 5 reasons why you should consider purchasing property in a limited company.
Number 1, and probably the most important one, is that this structure can allow you to pay less tax. Now, nobody wants to pay more tax than they technically should be, but let's be clear. If you want to pay no tax, then there is one amazing way to make sure that you do that, and that is to make no money. So the point here is that you can't not pay tax, and nothing about what we're going to teach you is about avoiding tax. That's not the goal here. The goal is to be operating your business in the most tax efficient way.
If you are buying properties in your personal name and you are receiving income from the rents of your buy-to-let properties, then you have absolutely no choice but to pay tax on that income on top of any already existing income that you make from your job or any self-employed work that you do. Whereas in a limited company, the rents from your properties get paid into the bank account of the company and not your personal bank account. So you are a separate legal entity from your company. You, as the director of your company, get to choose whether or not you pull money out of the company and into your personal name, your personal bank account, also known as transferring yourself money or paying yourself. And we call this a salary or a dividend payment. So if you don't pull out any money from your company, then you won't have to pay tax on it in your personal return. But you will, however, still be subject to corporation tax at between 19 to 25%, depending on how much profit your company is making, your property company. So if your company is reporting no profits because your expenses outweighed your income in the first few years, you just had so many costs and expenses, then you would pay no tax.
Now, before we carry on, if this is helpful, please click on the link in our description and check out our website to sign up for our newsletter or contact us about mentorship.
And don't forget, if you're not already a subscriber on our channel, then please do click that subscribe button. It takes just a second and it really helps us out.
So let's give you an example. People who are earning between £50,000 and £125,000 per year, these people are subject to the higher rate of tax here in the UK. Now, they pay 40% tax on their income.
People who earn over £125,000 are paying 45% tax, and this is called the additional rate taxpayers. Now, corporation tax used to be 19%. It's only 19% if you're making less than £50,000 per year in profit, which in the first few years of running your property business is likely. Looking at the overall picture, a 19% tax rate is just a lot more palatable than a 40% tax rate if you were reporting those profits in your personal name.
Now, the second reason why you really should have property in a limited company is that you can deduct the finance costs. If you are purchasing a property, or maybe you have property in your personal name right now, there's something called Section 24. Section 24 means that you can't deduct your finance costs off the expenses. So let's say that you've got a mortgage that you're paying on that particular property. You've got interest that you're paying on the mortgage, whether that's an interest-only mortgage or whether that's a capital and interest mortgage, you're still paying interest. And you can't deduct that as an expense, which in our opinion is probably something that the government are doing more so to push landlords to become more professional, to operate more as a business.
Whereas if you operate under a limited company structure, you can legally deduct these finance costs, which obviously increases your expenses and makes your taxable income less. Now, the third reason why you might want to consider purchasing a property within a limited company rather than in your personal name is that you have what is called limited liability. For anybody that knows about company structure or limited company structures, it inherently comes with limited liability. So earlier on, when we were saying that a limited company is separate from you as an individual, that is a huge benefit when it comes to limited companies, because it's like security when things go wrong. So for example, if your company owes somebody money but was unable to pay them back, then what the limited liability means is that you personally can't be held liable to pay back that debt that your company owns, because you are not your company. So it's the company's debt, not your personal debt. They can't come after you.
There is a small caveat though.
Yes,
and
there is.
I remember when I first got involved in this property business, because I'd always been PAYE, I never really understood that. So I was like, oh great, we can go buy all these houses, and
if we default, it's not a
if
problem.
we default, it's not a problem. But there is a small caveat, because in the time that we've been investing in property, mortgage lenders have always been super savvy and smart about this legal benefit of limited companies. Therefore, whenever we have taken out mortgages in our limited company name, they have always made us sign PGs, which are personal guarantees, essentially meaning that if we were to default on our mortgages, they could come after us personally.
And they could get their money back from going after anything we have, any assets. For example, they could repossess our personal residence, our home address. They can just get it back in any way. So this is because mortgage lenders, they need to protect themselves. They need to make sure that they're not exposing themselves to risk by lending you money as a limited company. So that benefit of having the limited liability is kind of wiped away when it comes to getting a mortgage on a buy-to-let property. I've yet to come across a lender that has not made us sign personal guarantees, and it's a pretty scary thing when you have to sign them, because you have to get independent legal advice, which costs quite a bit of money, and you basically sit down and they tell you that this mortgage company basically will come for you if you ever default. It's quite a scary experience, isn't it, the first time?
It is. Although technically that is meant to be a benefit of a limited company, we haven't necessarily seen the fruits of that yet.
Yeah, it just hasn't happened for us, has it?
No.
So actually, as AK said, the limited liability benefit that a limited company comes with isn't actually much of a benefit when it comes to buying property.
In that scenario.
In that scenario, exactly. Because lenders understand what limited liabilities are, and they just want to mitigate their own risk.
So the fourth reason to consider operating within a limited company is that it's very easy to add or remove directors. So if you are planning for the future, and I was actually speaking to somebody the other day about this, and maybe you want to be building a property portfolio for your family that you can hand down over the generations, well, it's actually very simple to add your children and make them become directors of the limited company.
And it's also possible to remove yourself as a director once your children perhaps come of an age where they could run the business if that's what they wanted. So it's very easy to pass down the company without worrying about things like inheritance tax on all of your properties and all of your assets being subject to this huge 40% inheritance tax that people get really hit with, and it's so damaging to families. So this would not be the case at all if you owned everything in your personal name. It would make you completely exposed to 40% inheritance tax depending on the value of your portfolio. Operating as a limited company potentially makes you very tax efficient when it comes to planning for the future.
Once again, you are not your company, so your children will not pay 40% inheritance tax as long as you do this at the right time and also in the right way.
So the fifth and final reason why you should think about creating and purchasing property in a limited company is so that you could create solid foundations with which to build your property business.
Speaking from experience, when you are buying in your own personal name and you're using your own personal bank account, there are so many unrelated transactions that are going through, meaning that when you actually come to do your accounts, you have to sift through all these transactions to work out which ones are business related and which ones are personal, and it just becomes a bit of a nightmare. And I remember when I first started this, Leah was trying to explain all this to me, and I was sort of weeding through the different transactions between which ones were technically valid for the business and which ones were, my 6-pack of M&S boxes, for example. So it's trying to weed through those.
But if something is all in one company, it just becomes so much simpler to do all the bookkeeping either yourself or when you hand all of that over to your accountants to do the bookkeeping for you. Everything is in separate company bank accounts, entirely separate from your personal expenses like Sainsbury's or whatever, and it's all business related transactions.
Yeah, and it just looks a lot more professional too. So as I said, when you have to send bank statements to mortgage lenders, for example, they are not going to see 6-pack of men's boxer briefs on that statement.
That's right. And they do ask for your bank statements the last sort of like 3 months, 6 months. So be prepared to send them.
So just to summarise, purchasing property within a limited company allows you to generally pay less tax. You are legally able to deduct the finance costs. You have limited liability, thus giving you more protection. It's easy to add or remove directors, allowing you to pass it down to your family.
And it's just more professional. It sets you up better in the long run if you're planning to do this professionally and sustainably. Lastly, please remember to speak to a property accountant about your personal situation because everybody is different here, so we can't speak for all of us.
And if you found this video useful, then head over to our website and sign up to our newsletter for more advice and tips on property investing.
Thanks so much, and we'll see you in the next video.
Bye.
Bye.